Now let us discuss section 36, and 36 talks about specified deductions. That means whatever is mentioned under section 36, that is allowed as deduction while computing your business income. Now you all have done accounting from 11th class till now. You know accounting very well. In accounting, what we do? In accounting, we take incomes on the credit side, and on the debit side we write the expenses. Once we write credit side all incomes, on the debit side all the expenditures. So what we'll do? Credit minus debit we do, and whatever result comes, that is basically the net profit. And we can also sometimes get net loss also. If suppose expenses are more and incomes are less, then net loss comes in our P&L account. Now when we compute the business income under the head pgbp, something similar happens actually, but only thing what happens is accounting the rules are different. Income tax the rules are different. Income tax, lot of conditions come for actually claiming the deduction. If you want to show this as expenditure and get the deduction for it, there are certain conditions. If conditions are satisfied, then claim it as deduction under income tax. If conditions fail, you cannot claim it as deduction. So till now we completed the discussion about section 30, 31, 32, 33, 35, that how we can claim the deduction for different items. 36 also talks about some more items. Actually major items come under 36 only. Okay, so this is very important. Now let's start with one after the other. Now first is insurance premium on stocks and stores. Basically, if you are a trading organization or you are a manufacturing organization, you will have a lot of stock in trade with you, correct? So stocks, stores, raw materials, all that will be there for either processing or for sale. Now in this case, when you maintain the stock, you do the insurance of that stock in trade, and for that you pay premium to the insurance company. That premium is allowed as deduction under section 36 subsection 1 clause 1. Clear? Now here 36 subsection 1 clause 1 only talks about insurance premium on stocks and stores. Now business has buildings, business has plant and machinery also, correct? But insurance premium paid on the insurance of building is claimed as deduction under section 30. For plant and machinery and furniture, if you have taken insurance, you can claim it as deduction under section 31. In 36 section, we only claim deduction for insurance premium on stocks and stores, right? So insurance premium on stocks and stores will be claimed under section 36 subsection 1 clause 1. So we have to do some comparison with the past data so that you will be able to connect and remember. Now second point, see, observe, this is very important. Now the insurance premium you may have actually paid or you would have incurred. It's all okay, but you have to follow the method of accounting. I'll tell you very proper way, something which is very important for you. Actually what happens is there are two heads of income, like pgbp is there and other sources is there. Here your income is computed as per the method of accounting you follow. Suppose you follow method of accounting, that is cash basis of accounting. Then insurance premium can be allowed only when you pay. That means actual payment is required to claim deduction. But if your method of accounting is mercantile basis, accrual basis of accounting, then even if the insurance premium is due, then also you can claim the deduction. That's what the meaning of paid here. Okay. So chalo, what we discussed, section 36 subsection 1 clause 1, it talks about insurance premium and stocks and stores. It is allowed as deduction, absolutely yes, but based on method of accounting. If your method of accounting is cash, then allowed on actual payment basis. If your method of accounting is mercantile or accrual basis, then even if it is due, then it is allowed as deduction. Right? Insurance premium on the building is allowed under section 30, and if it is on plant and machinery and furniture, then allowed as deduction under section 31. Only on stocks and stores under section 36 subsection 1 clause 1. Clear? Now come to insurance premium on the life of cattle under section 36 subsection 1 clause 1a. Now you may ask a question that why will anybody take insurance on cattle? As a student, our mindset is restricted, limited to our circle. But think about Amul, the taste of India. Yes or no? Like that, it is a cooperative society. Amul is not a company. It is a cooperative society. Now think about that Amul has lakhs of members. Lakhs, I can say. And many farmers are there who are members of Amul Cooperative Society, and all the members have lot of cows and they supply milk to Amul company. Now, what happened? Amul took the insurance of all these cattle. Now, cattle are not maintained by Amul. Cattle are maintained by the members of the Federal Milk Cooperative Society, that is by the farmers. But who took the insurance? Amul took the insurance, or Federal Milk Cooperative Society took the insurance. So the insurance premium paid will be allowed as deduction under section 36 subsection 1 clause 1a. Here paid means paid or due, both are okay. Right? Now come to the third point. Insurance premium on health of employees under section 36 subsection 1 clause 1a. Oh, 1b. Right. So 36 subsection 1 clause 1b. Now I am talking about health insurance. See, life insurance is different. Health insurance is different. Okay. So life insurance is different. Health insurance is different. So here I am talking about health insurance. So if the employer has taken health insurance policies and is paying premium, that will be allowed as deduction. But the payment should be otherwise than in cash. So two things are very clear. One, if the insurance premium is due, it is not allowed as deduction. Clear? And second thing, the payment should be made through account pay, check, demand draft, or any other electronic mode. If it is paid in cash, not allowed as deduction. Now from where the insurance should be taken? General Insurance Corporation of India. And that insurance scheme should be approved by central government. Sometimes the insurance can be taken from any other insurer, like you can say SBI Health or HDFC Health insurance policies are there, Star Health is there. You can take from any other insurer, it's okay. But that insurance policy should be approved by IRDA, Insurance Regulatory Development Authority. Insurance Regulatory Development Authority. So very clear to you, insurance premium on the health of employees under section 36 subsection 1 clause 1b is allowed as deduction only on actual payment, that too through account pay mode or account pay check, demand draft, or electronic clearance system, or any other electronic means. But if it is paid in cash, not allowed as deduction. Right? And the health insurance should be a scheme as per the General Insurance Corporation approved by central government, or it can be by any other insurance approved by IRDA. Now I'll just give you one hint how PGBP problems are solved. Okay. Now suppose health insurance premium paid by employer. In accounting, we directly debit it. Now if it is paid in cash, if it is due, if it is suppose paid through account paycheck, anything, insurance premium will be allowed as deduction in accounting. But income tax will allow only if it is paid through account paycheck, demand draft, right? Suppose if the payment is through account paycheck, demand draft, and income tax will allow it as deduction, accounting also allowed it as deduction, no problem at all. But if suppose if it is paid through cash, then accounting will allow it as deduction, but income tax will not allow as deduction. Okay, this difference you are clear? Now what happens is, when we solve the long problems in pgbp, we start with the net profit, and whatever differences are there as per accounting and income tax, that differences are adjusted. Like example, if insurance premium on the health of employees is paid in cash, accounting will debit it, so profit will decrease. But income tax say we will not allow it as deduction because it is paid in cash. So as per income tax, it should not have been deducted. So as per income tax, it is wrongly deducted and profit is wrongly reduced. So you have to correct it. How will you correct? If suppose something is wrongly deducted, to correct it, what we will do commonly? Add back. Yes or no? So when you compute your business income, long problems, you will take net profit, and health insurance premium paid by employer in cash will be added back. Same way you have seen under section 32 depreciation also. Depreciation is allowed as deduction, but accounting depreciation is wrong. So we will add it back. And depreciation as per income tax is right, that will be deducted. So this way, whatever is right as per income tax, we will try to bring that income by doing some adjustments with net profit. Hey, I give you some hint only to understand the long problems when we solve. As of now, you are clear with this. Shall we go to the fourth point? Now, bonus and commission. Section 36 subsection 1 clause 2. Okay, section 36 subsection 1 clause 2. Simple bonus and commission will be allowed as deduction on actual payment basis, right? It is not allowed on due basis. It is allowed only on actual payment basis. But why? But what time we should pay? By what time we should pay? The answer is simple. Bonus should be paid as per the respective due date under that law. Right? Minimum Wages Act is there. New wage code is there. So as per the new wage code, whatever the due dates are, as per that due dates, if bonus is paid, then income tax will allow it. Okay. So you need not just pay in the previous year. If you pay little later also, no issues. But only thing is, did you pay as per the respective law's due date? That's it. It is allowed as deduction. But what about commission? Commission, there is no separate law. So commission should be paid as per the due dates of Income Tax Act. Like if you are a company SSC, for you audit is compulsory. So till 31st October you should file the returns. 31st October of the assessment year. Till that time at least you should pay the commission. If you are an individual business SSC, not subject to audit, till 31st July you can pay the commission. Then only you can claim the deduction under the income tax return of the respective assessment year. Okay, this is what bonus and commission. And you know the meaning of bonus, right? Bonus is a part of the profit distributed to the employees. Okay, correct. And commission given to salesmen basically, right? As a percentage of sales to motivate them to sell more. Correct. Now come to the very important point, interest on borrowed capital. Section 36 subsection 1 clause 3. Now, should interest be allowed as deduction? The answer is absolutely yes. It should be allowed. But please remember, if you have taken the loan for personal purpose and you are paying interest, that is not allowed as deduction. But if you have taken the loan and that loan is used for the purpose of business and interest is incurred, so you are liable to pay interest or you actually paid the interest, then interest is allowed as deduction. So what are the three conditions? You should have taken the loan, right? Second thing, used for business and profession. The loan money should be used for the purpose of business and profession. And third thing, you should have incurred interest on it. If all these three conditions are satisfied, then under section 36 subsection 1 clause 3, interest is allowed as deduction. But relating to this, there are so many discussions to be done, because this forms the major expenditure for any businesses, right? So lot of controversies are there. Chalo, I'll ask you certain questions, you try to give me answer. Suppose you are a sole proprietorship business. You are a sole proprietorship business and you gave the loan to your business, and as a business, whatever interest you pay to yourself, you want to claim it as deduction. Can you claim so? I gave the answer itself, right? You understood. Very good. Not allowed as deduction. Q? Because sole proprietor and the business are one and the same. Now, suppose yours is a partnership firm and you gave loan to your partnership firm. In that case, whatever interest paid to you, that is allowed as deduction for partnership business. Correct? Yes, it is allowed as deduction. For income tax purpose, you as a partner is a separate assessee and partnership firm is a separate assessee. So that's why it is allowed as deduction. But more discussion about it under section 40B when we discuss. Suppose example, interest on capital. In partnership, interest on capital is there. Can we allow it as deduction? Under section 40B, yes, it can be allowed as deduction. No problem. But again, certain restrictions are there. We will discuss at the time when we discuss 40B. Right? Suppose you have a company. In the company, you are paying interest on the share capital. Now, for share capital, a part of profit, dividend will be paid to the shareholders. But there is no concept of paying interest on share capital by a company. So if interest is paid, that is not allowed as deduction for companies. Right? You have to be very clear about. Suppose you took the loan for purchase of a plant and machinery. For the business only, plant and machinery. So will the interest be allowed as deduction? The answer is absolutely yes. But till the interest paid till the date of asset put to use, like you took the loan, after getting the money you searched for the asset, when you found the right quality of asset you purchased it, then you have installed it, then you started your production. So when you start using that asset, till that time whatever interest was charged, that will be added to the cost of the asset. Added to the cost of the asset, and that you will claim depreciation under section 32. But after the asset is put to use, any interest is paid, that will be allowed as deduction here under section 36. So there are so many things which we have to discuss, right? Some case studies are there, some points are there. Just let us see all the notes and discuss fatafat all the points. Okay. Now see these other points. What they said: interest paid to another person. So if you have paid interest, it should be allowed as deduction. The answer is yes. If it is paid to other person, definitely it should be allowed as deduction. Right? But if it is paid to proprietor, you can see in the second line, that will not at all be allowed as deduction. But suppose you are paying to partners as interest on capital, then it is allowed, as I said, under section 40B. Okay, very good. Suppose your organization has two departments. So one department purchased some material from another department. Now, because there is a delay in payment, some interest is charged. Now that interest, will it be allowed as deduction? Or suppose one department took loan from another department. Think about Adani. Adani's one company takes loan from another company. In that case, if it is different companies, then definitely allowed as deduction. But if it is same organization and you are paying interest to other department, right, one unit taking loan from another unit and paying interest on it, it will not be allowed as deduction. Because when you file income tax returns, you file for the organization, not for the departments. Okay, very good. Interest paid to relatives, is it allowed as deduction? Absolutely yes. You can take loan from relatives. What's wrong with it? But if your payment is more than the market rate, suppose market rate of interest is 12% and you are paying 30% interest to your relatives, so the excess payment is disallowed. Excess payment is disallowed. Okay, not allowed as deduction. Right? So I said 30% you are paying and market rate is 12%. So that extra 18% is disallowed. But whatever I said disallowed is given in section 40. Section 40 is relating to excess payment to relatives, is a discretionary section of the assessing officer. Discretionary means if assessing officer wants, he will disallow it, otherwise ignore it. Okay. So if in the question they give that assessing officer disallowed it, then we have to add back. Yani wrongly deducted expenditure, what we'll do to correct it, we'll add back. Okay. Chalo, let's see the fourth point. Now, why the loan is required or not required? Are yaar, who are you? The income tax officer. It's my business. I will decide whether I need the loan for my business or not. Assessing officer has nothing to do with it. Assessing officer can only check whether the loan taken is used for business. Now it is genuine need, not genuinely needed, it's not his duty. So if tomorrow you get a question in the in the exam that assessing officer feels that it was not required for business, so that's why interest is disallowed, this is wrong. Was the loan taken? Was it used in the business? And is interest paid on it? That's it. Okay, deduction can be claimed. Next point, interest on share capital by the company not allowed as deduction. Right? Interest for the next point, you can see sixth point. Right? Now, if you have taken any loan and the loan is taken before the start of the business, before commencement of business, or before the asset is put to use, that interest will be added to the cost of the asset. Right? It will be added to the cost of the asset. And if any interest is paid after putting the asset to use, that will be allowed as deduction under section 36 subsection 1 clause 3. Very good. Borrowed capital, borrowed money used partly for business and partly for other purpose. So whatever proportionate you used for business, that only you can claim it as deduction. Suppose you took loan of 10 lakhs rupees, 6 lakhs for business, 4 lakhs for personal. Then on 6 lakhs, whatever interest is there, on business portion of loan, whatever interest is there, that is allowed as deduction. Eighth point you see. See, interest on money borrowed to pay income tax. This is disallowed, not allowed as deduction. Okay, that we'll discuss under section 40. But if suppose you have taken in interest, you are paying interest on money borrowed for payment of GST. Here sales tax is written for our practical understanding, GST. Or suppose it is customs duty, that means any indirect tax, then such interest is allowed as deduction. Okay, interest on loan taken to pay income tax is not allowed, but interest on loan taken to pay GST, customs duty or any indirect tax, that is allowed as deduction. Okay, interest paid outside India, please remember TDS should be deducted. If tax is deducted at source, which we studied in house property, the same provisions apply here. If tax is deducted, then only interest is allowed. If tax is not deducted, interest is not allowed. Now here we just wrote deducted, but in practice it is deduction and depositing with government. These two conditions are required. Okay, that we'll discuss under section 40 in detail. Okay, now come to the 10th point. Revenue. Arey, you took the loan. After taking the loan, you use the money for regular operations, revenue purpose or capital purpose, doesn't matter. Okay, now suppose 11th point you see, interest on money borrowed for investing as capital. Now I'll tell you, a partner has taken the loan because he want to invest in the partnership firm. Now whatever interest he is paying on the loan, that is allowed as deduction for the partner when he is filing the returns, right? So interest on money borrowed for investing as capital in partnership firm is allowed as deduction, right? But here please remember that it is allowed as deduction to the partner because he is paying interest. Okay, now brokerage and commission. For taking the loan, you may have to meet a broker, right? He will do all the work for you, right? You may have paid commission to somebody. That commission and brokerage will not be allowed as deduction. Now come to the 12th point. Other interests are there. This you should be very careful. Some extra points are there. Interest other than interest on borrowed capital, right? So on borrowed capital till now we discussed it, but we are just talking about other interest now. Example, interest on deferred payment for purchase of assets. Sometimes you delay in payment, so they charge extra interest, right? Interest on delayed payment of electricity. Sometimes you delayed the payment of electricity or water or property taxes, so you may have to pay some interest for delay. Interest on purchase price of raw materials, so you delayed in payment of raw material, there also some interest is charged. These type of interest are a type of penalty, so that's why they are not allowed under this section. Okay, under this section it is not allowed, but they can be claimed under section 37. That is basically it is general deductions. Section 37 always talks about general deductions. There such interest can be allowed as deduction. Okay, very easy, right? Shall we go to section 6th point now. Now zero coupon bonds. Yes, discount on zero coupon bonds are allowed as deduction under section 36 subsection 1 clause 3a. Now what is this? Actually, zero coupon bonds are issued either by infrastructure capital companies, infrastructure capital fund, public sector undertakings or scheduled banks. Hey, come on, repeat with me. Infrastructure capital companies, infrastructure capital fund, public sector undertakings, and scheduled banks. Any of these four can issue zero coupon bonds. Now the special point is, like a normal loan is there, right? Normal loan, what will happen? If suppose you took the loan from a bank, you pay regularly every month interest to the bank, correct? This is normal loan, which we discussed just before. But in zero coupon bonds, what happens is they don't pay anything during the period. Suppose in 2018, suppose State Bank of India is a scheduled bank. So State Bank of India issued zero coupon bonds. And that zero coupon bonds are going to mature in 2023. Now between 2018 till 2023, SBI will not pay a single rupee to the bondholder. Suppose I purchase the bonds, SBI will not pay a single rupee to me. Right? So during the tenure of the bond, a single rupee will not be paid. So when everything will be paid? Only on the maturity or redemption. Okay? And what is a zero coupon bond? That will be notified by the central government. So what is a zero coupon bond? For that we discussed just three conditions. They are mentioned under section 2 clause 48. What is a zero coupon bond? Again I am telling. These are bonds issued by infrastructure capital company, infrastructure capital fund, scheduled bank, public sector undertakings. They don't pay anything during the period of the bond, but payment is done only on the maturity or redemption. And that bond is called as zero coupon bond only if it is notified by the central government. This is what section 2 clause 48 talks about. Now the point comes, okay, but if they pay at the end, they should claim the deduction also, right? Suppose example, when our NTPC, National Thermal Power Corporation, is a public sector undertaking, they issued a zero coupon bond, suppose 5 years. They said today you pay 60 rupees and after 5 years they will pay back as 100 rupees. Okay, so what I spent 60 rupees, what I am getting back after 5 years 100 rupees. Now this difference 40 rupees, this difference is what? 40 rupees. That is the discount on zero coupon bonds. Now when the NTPC should claim the deduction of 40 rupees. Now payment is done on the maturity, but deduction they can claim every year. So what they do is they divide the whole into months. Like whatever 5 years period is there, they first divide it into months. And once the number of months are ready, clear, whatever discount is there, suppose 40 rupees is the discount, they divide it by number of months and accordingly they will claim the deduction under section 36 subsection 1 clause 3a. Now you may be thinking, suppose sir, if the zero coupon bond is issued on 20th of this month, so what about these 10 days? Should we consider this as month or should we ignore it? The answer is ignore. They call it as a month if it is 15 days or more. If the period of the bond is 15 days or more, then only they consider it as a month. If it is less than 15 days, that month is ignored. Keeping this into criteria, number of months are decided. And once they are decided, discount divided by months will become your monthly discount. Total discount 40 rupees divided by months will become discount per month. Now in your previous year, suppose our previous year is 22-23, right? 1st April 2022 to 31st March 2023. Now during this period, whatever, how many months are there? Suppose example, on 1st July the bond is issued. So 1st July 2022 the bond is issued. So 22 July, August, September, October, November, December, January 23, February 23, March 23. So 9 months will be the period of bond, right? So 9 months into monthly discount will be allowed as deduction here. Suppose on 20th July they issued the bond in the current previous year. So that 10 days will be ignored, correct? Because less than 15 days. So July you ignore. From August 2022 to March 2023, 8 months will come. So 8 months discount only will be allowed as deduction here. Like that every year they claim the deduction. Deduction is claimed every year by these organizations. But when will they pay the entire money? Only on maturity. Okay, clear? Shall we go to the next word? We discussed infrastructure capital company and infrastructure capital fund. Now infrastructure capital company is defined under section 2 clause 26A. Infrastructure capital fund is defined under section 2 clause 26B. Now basically both these do only one thing. देखो, company is a company, incorporated entity under Companies Act 2013. Fund is nothing but a trust. They create a trust deed is registered, there are certain trustees, so we call it as fund. Okay. Now whether it is infrastructure capital company under section 2 clause 26A or infrastructure capital fund under section 2 clause 26B, both do commonly two things. One, invest in shares of companies, and second one, give long-term loans to the companies. Like there are companies like L&T is there, Janapriya Apartments are there, Tata Housing is there. So whatever infrastructure related companies are there, to such companies, these companies will either invest in the shares and purchase the shares, or these companies or funds will give long-term loan to these infrastructure based companies. Clear to all of you? Very good. Now which type of projects they will fund? So those businesses which are mentioned under section 80IA or under 80IAB, right? If a company is mentioned under section 80IA, a particular nature of business is mentioned under section 80IA, which we will study in the deductions chapter, or under 80IAB, which again we will study in the deductions chapter, or under section 80IB, which is relating to housing projects, or a hotel which is 3-star or more, or hospital with 100 beds or more. If any of these four are there, in that they will invest. So businesses which are mentioned under 80IA, IAB, or housing projects mentioned under section 80IB, hotel which is 3-star or more, hospital with 100 beds or more. So these are the four areas in which these people give long-term finance or invest in the shares. Now how can we say the hotel is 3-star or more? That rating is given by the government. Okay. So we discuss section 36 subsection 1 clause 3A, discount on zero coupon bonds. Zero coupon bonds are mentioned under section 2 clause 48. 2 clause 48. What are they? Those which are infrastructure capital companies, infrastructure capital fund, or public sector undertaking, scheduled bank. Basically they issue the bonds and take the money from the people and repay a fixed amount at the maturity or redemption. And only when central government notifies certain bonds as zero coupon bonds, then only they become zero coupon bonds. Treatment pro rata basis, monthly deduction is given. Even though the actual payment by them will be done at the maturity, but income tax deduction is allowed every year. If the month, calendar month, is more than 15 days, consider that month. If that month has less than 15 days of the bond period, then ignore such month for calculating monthly discount. How will you get total discount? The maturity amount minus whatever the subscriber pays. Divide it by number of months as I counted, and monthly discount you will get. Whatever monthly discount pertains to this period for this previous year, that you claim it as deduction. What are infrastructure capital companies? Discussed under section 2 clause 26A, and infrastructure capital funds are trusts which are mentioned under section 2 clause 26B. Basically, these give long-term finance to infrastructure companies, or they invest in the shares of infrastructure company. Which type of companies? Those which are mentioned under 80IA, 80IAB or 80IB, or hotel with 3-star or more accommodation, hospital with 100 beds or more. Now come to the next point. If the employer contributes to the recognized provident fund or superannuation fund, right? These are funds for retirement benefits of the employees. The contribution by the employer, which is mentioned or restricted by the 4th schedule, that will be allowed as deduction. But by what time the employer should pay? Before the due date of filing the income tax returns. Okay. If employer contributes to the recognized provident fund, employer contributes to the recognized provident fund or approved superannuation fund, then he can claim the deduction for the contribution. But the payment should be done at least before filing the income tax returns. Where this is mentioned, section 36 subsection 1 clause 4. Okay. Similarly, the employer may contribute to new pension scheme or notified pension scheme under 80CCD. Now, what are notified under 80CCD? Central Government Health Scheme, CGHS, Atal Pension Yojana, right? Atal Pension Yojana or Central Government Health Scheme, right? Or NPS. These three are mentioned under 80CCD. If you are contributing to that, then you will get deduction under section 36 subsection 1 clause 4A. Okay, very good. But then how much contribution can be done? It's employer's choice, boss. But how much deduction? Deduction is simply 10% of the salary. Right? So whatever employer's actual contribution or 10% of salary, whichever is lower, the deduction will be allowed. But sir, what is salary? Salary is equal to basic pay plus DA retirement. What is salary for notified pension scheme? Basic pay plus DA retirement. By what time the payment should be done? Of course, till the filing of income tax returns. The money should be deposited with the NPS authorities. In RPF case, with the Employees Provident Fund Authority. Central Board of Trustees is or set up for that. Okay. Are you able to connect with what I said? Very good. I'll tell you that there is another fund called as Statutory Provident Fund. This is actually government fund. So if government is contributing, government will get deduction, but not under section 36, but under section 37. Okay, this also you should keep in mind. Now one more thing, there is approved gratuity fund, right? Suppose employer contributes to the approved gratuity fund every year, some amount they contribute, then they will claim deduction under section 36 subsection 1 clause 5. Only condition is the payment should be done to the respective fund before the due date of filing the income tax return. Before the due date of filing income tax return, if the payment is done, that's it, he can claim the deduction. Okay, so we discussed three things till now: RPF and superannuation fund under 36 subsection 1 is common for all, right? So under clause 4, then I said something called as new notified pension scheme, clause 4a, and last thing, approved gratuity fund, clause 5. For all these, whatever employer contributes allowed as deduction, but deposit should be done before filing the income tax returns. In notified pension scheme, restricted to 10% of salary. Salary is equal to basic pay plus DA retirement. This you should remember. Okay, now let's discuss about staff welfare scheme. Now very interesting topic, contribution by the employee. Till now I spoke about employer. Like employer contributed to RPF, superannuation fund, gratuity fund or NPS, all that I discussed about employer till now. Now this point, section 36 subsection 1 clause 5a talks about contribution by the employee towards the staff welfare scheme. Now I was shocked actually that if employer contribute, why will the employer get deduction? Question is genuine, right? If employee contributes, from his salary it is deducted, why will employer get deduction? Right? Section 36 talks about employer yani businessman's deductions, right? That's what we are going to answer now. Okay, so first thing, here employee is going to contribute towards provident fund, superannuation fund or other funds like ESI or maybe any other staff welfare related fund. Again I am repeating for you, it may be provident fund, it may be superannuation fund, it may be ESI related fund or any other fund. Simple? Okay. Here employee actually contributed. Now will employee go to the fund and deposit the money there? Actually no. So what happens? Actually what happens is the employer will deduct the contribution of employee from the salary and only the balance portion is paid to the employee. Now when the employer deducts, suppose example your salary is 1 lakh rupees and 12% provident fund contribution has to be made. Suppose 1 lakh into 12%, 12,000 has to be contributed by you. Okay, so you will not get 1 lakh salary and go to the EPF authority and deposit 12,000. It will not happen. What happens is employer will deduct 12,000 from your salary, that is 1 lakh minus 12,000, and 88,000 he will pay to you, and 12,000 employer will deposit with the government or EPF authorities. This is what going to happen. Now from your salary it is deducted, it is deposited with the respective authorities by the employer, then why he should get deduction? Correct? The reason is when he deducts the amount, he keeps that amount with you himself, correct? He keeps the amount with himself for some time. So government said that when he keeps the amount with himself, it is employer's income. It is employer's income, taxable income. And when he deposits with the government on time, he can claim the deduction under section 36. So what are the two things I said? When he deducts it, when he deducted 12,000 from your salary, he has that 12,000 with him, correct? That 12,000 belongs to the employee, employer keeps with himself, right? That 12,000 is employer's income. And when that 12,000 employer deposits with the authority, then he will claim deduction under section 36. Clear? This is what they said. Now, I'll tell you. Every law has a respective due date. Like you think about ESI. So January month's ESI contribution you should deposit till February 21, yani 21st of next month. February month's ESI contribution till March 21. Like that it continues. Same way with Provident Fund, they say 15th of the next month. That means January's contribution till 15th of February. February contribution 15th of March. So Provident Fund 15th of the next month. ESI 21st of next month. So employer should not only deduct this 12,000 from your salary, but his responsibility is to deposit before that due date. Okay. If suppose he deducted and deposited in time, then you can ignore, no need to do any treatment. Right, in analysis section you can see no need to do any treatment. But if suppose he deducted from your salary and did not deposit within the due date, then it will be treated as his income. And which income? Business income. Okay, this you should be clear. Now let us discuss in relation to dead animals. You get deduction under section 36 subsection 1 clause 6. Simply remember, animals are used in many businesses, especially agriculture related businesses. Animals are used, but animals are livestock. So over the period of the life of the animal, you cannot claim depreciation under section 32. You cannot claim depreciation under section 32. So when the animal becomes useless, when the animal dies, at that time you claim the deduction. Suppose you purchased the cow for 1 lakh rupees and the cow died, and when you sold the flesh you actually got 10,000 rupees. So how much is the difference? 90,000 rupees. 1 lakh is the purchase price and the carcasses or flesh you sold for 10,000. This 90,000 you can claim deduction under section 36 subsection 1 clause 6. Clear or have any doubt? Hopefully super clear. Now please remember that animal should not be stock in trade. Like there are many slaughtering houses whose major business is to breed the hens, cattle, then slaughter them and sell the flesh, the meat. So for them this deduction is not available. Okay, those animals which are used in the business for production, like agriculture we can say, or dairy farms we can say, for them this deduction under section 36 subsection 1 clause 6. Okay, shall we go to next point? In relation to bad debts, what is bad debts? Is this word right, bad debts? The answer is yes, bad debts. If suppose you have given any debt to any other customer, or you have sold some goods on credit to the customer did not pay your money, then it becomes bad, correct? So that is called as bad debt. For that you can claim deduction under section 36 subsection 1 clause 7. I'll give you one simple example and then we'll see all the 5 conditions relating to it. What happened is, some customer came to you. Chalo, customer's name is Sabjo, your customer's name is suppose Imtiaz. Imtiaz came to your store and said, definitely I'll pay all the money sir, don't worry, please give me goods on credit. So you believed the customer, you gave suppose 2 lakhs worth goods on credit to the customer called as Imtiaz. Later on, Imtiaz did not pay the money. Your policy is to get the money within 3 months. but he did not pay within 3 months, 6 months, 1 year. And your accounting policy says that if it is not paid within 1 year, hey, collection policy is you should collect the money within 3 months. But bad debts you will declare as per your accounting policy if you are not able to recover within 1 year. In corporates, there is a proper policy. What should be the collection period? If not collected within this period, when it should be declared bad debts. There is a proper policy. So till 1 year also he did not pay, so we declared it as bad debts. Now, is it right as per income tax? Can it be considered as bad debts? The answer to this is with these 5 conditions. First thing, was there any debt? Did you give any debt in relation to your business, in the course of your business, in the furtherance of your business? So you have a store, so you gave on credit certain goods. The answer is yes. First condition satisfied. Right? It is in relation to the course of your business. It is not personal. Right? It is not in the friendship you gave. It is in relation to business. So first condition satisfied in the case of Imtiaz bad debts. Second condition, did you consider or treat it as income? When you give the goods on credit, we call it as credit sales, correct? So credit sales is an income or not? We will write the entry of credit sales, correct? Creditor account debit to sales. So it is considered as income in your accounting books. Second condition satisfied. Now the point is you are not able to recover, so you have written off as bad in your accounts. Did you write the bad debts journal entry? Did you write it as bad debts in the P&L account? 2 bad debts. If the answer is yes, then third condition satisfied. One more condition is, is it a revenue item? Suppose if it is a capital amount, then you cannot claim it as deduction here. If it is revenue in nature, for a trader, regular sales on credit is a revenue item, correct? So this condition is also satisfied. Because it is in the course of business, because it was considered as income, because it was written off as bad in accounts, because it is revenue in nature, all conditions are satisfied. So you can claim this as bad debts. You can claim the default by Imtiaz as bad debts, nothing wrong with it. Suppose example, you gave some advance money to your supplier, that I am giving you some advance money, you supply certain goods. The supplier closed the shop and he ran away. Now you are not able to trace that person. Can we claim this loss of money as bad debts? The answer is, think. Absolutely no. Because when you paid advance to your supplier, it is not treated as income. Right? It may be in the course of business, but was it treated as income? It is not treated as income. So that's why you cannot claim it as bad debts. Correct? So this way there are a lot of things to read and discuss. So let us see the screen and discuss everything in detail. Okay? So as I discussed with you, section 36 subsection 1 clause 7 bad debts. Hey, bad debts is allowed as deduction, and please remember that assessing officer cannot say that should it be considered as bad debt, what is this policy, is it right or wrong, nothing. If as per your accounting policy you declared it as bad debt, in your account did you write it as bad debts? Yes, that's it. Income tax officer should allow it as bad debts, right? So he cannot, as an assessing officer, insist the assessee for producing or proof He cannot ask you that please give me the evidence that it has become bad debt. How can you give it any evidence for it, right? If some customer has not paid your money, can you create a proof that he has not paid? Somewhat you can do, but it is a controversial issue. That's why the income tax department said if you have declared it as bad debts in your accounts, that's it. Assessing officer cannot ask you to show some proof. Okay, now how can you claim it as bad debts? To claim it as bad debt, first the debt must be incidental to the business. It should be in connection to the business, right? Suppose if a lawyer is there, lawyer is giving loan to the client so that the client can purchase the property. Now tell me, if the client don't pay the money to the lawyer, can he claim it as bad debts? Now please remember, for lawyer, it is not his job to give loans, correct? Giving loan is not incidental to business, correct? That's why lawyer cannot claim it as bad debts. Now second point, B, the debt has been considered as income. Of course, if it is considered as income, like I said, na credit sales, if it is considered as income, then only you can claim it as bad debts. I also said to you that suppose you have given advance to the supplier and later on you did not purchase the goods. So the supplier forfeited the amount. He said your advance is cancelled, I'll not return it back. Can you claim it as bad debt? The answer is no. Simple reason being you did not treat it as income first, right? That's why you cannot claim it as bad debts. But anyhow, this is a general loss to you. You can claim it as deduction under section 37, right? In the ordinary course of business, this is a revenue loss to you, so you can claim deduction under section 37 subsection 1. Okay, this you should remember. If suppose customer became insolvent, your customer has become insolvent, and because of that it became bad debt, and you have given loan to the customer in your ordinary course of business and customer became insolvent, then definitely you can treat it as bad debts. Now when you give loan to your customer, did you consider it as income? No, right? Still you can claim it as bad debts and claim deduction here. That's what the exception is. Now come to C point. It must have been written off in the accounts of the assessee. Of course, if it is written as bad debts in accounts, then only you can claim it as deduction. Now, actual bad debts are allowed as deduction. If you have created a provision in your accounts, that will not be allowed as bad debts. Okay, right. Now in income tax, there is one more word which we have to remember, and that is ICDS, Income Computation Disclosure Standards. Now, as per ICDS, now as per accounts, something is not considered income. You did not write. But as per ICDS, yes, it is income. So for income tax purpose, it was income. Accounting purpose, it was not income. And what happened? You lost the money. So it is bad debts for income tax purpose as per ICDS. So you can claim it as deduction. And it is deemed that bad debts are claimed in accounts. Okay, right. These are high level advanced concepts, but simple. If any income is considered as per ICDS but not as per accounts, later on it became bad, so it is deemed that you have written off as bad in accounts and you can claim the deduction. if it is considered bad as per ICDS. Okay, very good. Next, D point. They said business must be carried on during the previous year. Now, if your business is closed down, then can you write off as bad? No, right? So that's why business should continue. That's what important. Bad debts of discontinued business is not allowed as deduction. Okay. So business should be existing to claim the deduction of bad debts. You have any other business, doesn't matter. If suppose you have clothes business, garments business, and you have ice cream manufacturing business, so clothes business is closed, ice cream is continuing, but can you claim bad debts for clothes business? The answer is no. Sir, I have other business too. No. If you want to claim bad debts for a particular business, that particular business should continue. That's what they said. Okay. Now, bad debts is not allowed to the assessee who maintains the books of accounts on cash basis. If you are maintaining on cash basis, then there is no bad debts to you, because you will not recognize any income on credit basis. Correct? If your business is cash basis, your income is also cash, expenditure is also cash. So there is no credit income, there is no bad debt. Simple, right? Bad debts are also allowed in the hands of successor. Suppose you as a businessman continuing the business, you transferred the business to father, your child. In that case, what happens? Okay, father gave the goods on credit to a customer. Later on, son can consider it as bad debts if the customer don't pay the money. Simple, correct? Now, recovery of bad debts. If you have recovered the bad debts, then it is an income. Even if your business is closed down, still, if you recover the bad debts, it is your income. Now, for you to understand, I have some things. Actually, these few lines, if you read, you will get confused. So, next page, we have a chart. Nice to see the chart. And in that chart, I'll explain to you everything. Okay. See this table, small table. What they wrote. I'll just give you some numbers, then try to understand. Suppose they gave in the question that your debtors are 45,000. That means customers are due to pay 45,000 as per your records. But income tax said no, 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 we will only consider 35,000 as bad debts. So as per accounts 45, as per income tax only 35 allowed. Now you recovered 25,000 out of it. You recovered how much? 25,000 out of it. So what is the taxable income? Question arises, and there are lot of adjustments in this regard. So write these three numbers and solve the question as per my explanation. Okay. See, first what they give, amount recovered. So what you recovered, write down 25,000. Okay. From that, deduct less bad debts claimed. So how much you claimed? 45,000 minus bad debts allowed. How much you allowed? Income tax department allowed 35,000, right? So 45 minus 35, how much will come? 10,000. So how much is recovered? 25,000. How much is deductible? 10,000. So what is taxable? Only 15,000. Okay. Are you able to understand what I said? This way you should be able to do it. Now simply remember that if your bad debts are 45 as per your interest, but income tax said 35,000 is only allowed under income tax. Now you recovered 25. You will simply say that in this 25,000, 10,000 are that which actually can be recovered as per income tax. So that I recovered. And balance 50,000 which I recovered, I felt that they were bad and I recovered now. So that's why 15,000 is taxable. Okay. Let's see the note. Such recovery shall be taxable irrespective of the fact whether the business is continuing or not. Very good. This way you should understand. Now come to provision for bad debts. Hey, this also will continue this way. Not at all important from your exam perspective, except for 1 mark. And that's how much we will read. Section 36, subsection 1, clause 7a. When we see this point A, they are talking about scheduled bank. Your State Bank of India, your Union Bank, Canara Bank, Bank of Baroda, all these are scheduled bank. So scheduled bank other than foreign bank, they said. Then they said non-scheduled bank like HDFC, right? Then they said cooperative bank like Telangana Gramina Bank. There are Deccan Cooperative Bank like that. But exclude your agricultural cooperative, they are not covered. Primary cooperative also not covered. Okay, primary agriculture not covered. So if scheduled banks are there, non-scheduled banks are there, that means private, public, all banks are covered here. But cooperative society is covered. But what are not covered? Foreign banks are not covered and agriculture cooperative society is not covered. For them, they can create 8.5% as provision for bad debts. Okay, how much they can create? 8.5% they can consider it as bad debts. But 8.5% of what income? 8.5% of income before deducting this provision and before deducting deductions under chapter 6a, that is 80C, 80CCC, 80C2, 80U tak. Before claiming deductions under section 18 and this provision for bad debts, whatever income was into 8.5%, you can create a provision. The best part is you can claim 8.5% as deduction also. Okay, chalo, very good. Now come to the additional deductions. What are the additional deductions? Suppose if it is rural bank, then it is not 8.5% but 10%. So for urban branches you can claim 8.5% and for rural branches you can claim 10%. That's how simply you should remember. Okay. And further they give you option that you can claim deduction. For what? If you get any income, that means basically we are all talking about banks only. Banks got income from redemption of securities, right? If they got any income from redemption of securities, generally they don't get any income. So if that happens, then they can claim it as deduction here. Simply that much. So you can totally ignore this redemption related point for your exams. Even in your practice also you may not use this. But as of now, just remember one word if you want to remember, that if banks or cooperative societies which are into banking get any income from redemption of securities, that is allowed as deduction. Okay, because banks are involved into the whole process, helping the businesses to redeem, so they get some commission on redemption. That income also they can claim it as deduction. Finally, B point you check. If it is a foreign bank or public financial institution like life insurance corporation, general insurance corporation, then there are something called as public finance, state finance corporation, respective states have, and they state industrial investment corporation or non-banking financial companies like Bajaj Finance, right? For this you can claim deduction up to how much? 5%. So simply remember these three words. If it is a bank, urban branch 8.5, rural branch 10%. If it is bank or cooperative society, 8.5 and 10, 8.5 for urban and 10% for rural. this much deduction can be claimed for provision for bad debts. And if it is a public financial institution or a foreign bank or state financial corporations or state industrial investment corporations and NBFCs, 5%. Okay, that's it. Now come to notes. What they said in case of persons. Now, if suppose you actually claimed the deduction of provision, can you again claim bad debts? The answer is yes and no. If suppose you get bad debts, how much you got the bad debts? Is it less than provision, equal to provision, or more than provision? If it is less than or equal to provision, then you cannot claim bad debts as deduction. If bad debts are more than provision, that additional bad debts which are more than provision, you can claim it as bad debts. Okay, because in accounting also, if you create a provision, you first adjust bad debts with provision, right? Only excess bad debts you show in accounts. Same thing here done. Okay, chalo, very good. Now rural branch, if the population of that area is less than 10,000 as per last census, it is called as rural branch. Come to the 14th point, deduction in respect of special reserve. Now section 36 subsection 1 clause E8. Hey, this will never come in exam, but anyhow it is there in the syllabus. That's why I am just reading for the sake of that there is some provision we should know. That's it. Okay. Now what they did, there is a deduction allowed in respect of the special reserve. Now special reserve is created, for that they are ready to give deduction. Okay. Now who actually created the special reserve? Specified entity from the specified business. Now what is specified business? I'll tell you. Just let's come to the table and see what is specified business. Specified business is all related to infrastructure. See what is specified business? All are related to specified infrastructure only. See, they said industrial or agricultural development. This is specified business. Or development of infrastructure. Okay. Or we can say development of housing in India. These are the specified businesses. Okay. Or they said construction or purchase of houses in India for residential purpose. Okay, these are specified businesses. Or development of infrastructure facility like roads, bridges, dams. These are specified business. Now for these specified businesses, now entities should be there, organizations should be there, and organizations are nothing but financial corporations. Like I said, na, our life insurance corporation is there. These are financial corporations, right? Or we can say some finance corporation, like finance companies are there, public sector companies are there. So public sector companies are there. So agriculture cooperative societies or credit cooperative societies, you keep out of it. Okay. Housing finance companies like HDFC bank is there, right? Or other financial corporations are there. So basically they are talking about finance based companies, okay, who are into banking and giving long term finance. If such finance based companies or banks or cooperative societies into who are into lending other than agriculture, if these people create a special reserve for these specified businesses like industrial development or infrastructure development or housing development, then they will get deduction, they said. Simple. Okay. How much deduction? Least of the three. A, B, C is given, you see. So how much they transferred to the reserve? That, or 20% of the profit, right, which is derived from the specified business from by providing long term finance. And third one is twice the amount of the paid up share capital and the general reserve. So paid up share capital plus general reserve into 2 you should do, or you take 20% of the profit from long term finance to these specified businesses. And third one, how much you transferred. Compare these three, whichever is lower will be allowed as deduction. Okay, that's it. Now suppose this whatever you transferred to special reserve is withdrawn, then what will happen? Whatever money is withdrawn is taxable as income under section 41. Okay, under section 41 it is treated as deemed income and taxed. Okay, 41 subsection 4a, it is treated as deemed income and it is taxed if you withdraw the money from specified reserve. That's it. Okay, let us discuss something about family planning expenditure. Such a long section to learn actually. Now we have very few things. Next 15 minutes we'll wind up section 36, 37 and 38. So don't actually skip or don't get bored, because lot of things we have to learn. Hey, first thing, even if you get bored, you have to focus on. Simple reason being, because examiner will not consider your mood for considering that how you performed, right? So let's start enjoying the lectures. Now expenditure on family planning, section 36 subsection 1 and clause 9. Hey, family planning expenditure. Now for companies they said something, I'll discuss first. For companies, if the expenditure is revenue expenditure, 100% allowed as deduction. If the expenditure is capital in nature, like purchasing equipments for all the surgeries, right? If the expenditure is capital in nature, deduction is allowed, but in 5 equal installments, right? For capital expenditure, deduction is allowed in 5 equal installments. For revenue, 100% in the same year itself. So I discussed about expenditure on family planning by the corporates. Revenue 100% allowed, capital it is also 100% but in 5 equal installments over a period of 5 years. Okay, now when I say capital expenditure, obviously it is purchase of plant and machinery, maybe construction of building, something like that. If you are claiming deduction under section 36 subsection 1 clause 9, then can you claim depreciation under section 32, or can you claim deduction under any other section? The answer is no. If you are claiming deduction here, then don't claim under at any other place. For capital expenditure I am talking about. Okay, sometimes what happens, you have all the incomes minus expenditures, like even revenue expenditure on family planning, capital expenditure which is 1/5 allowed, that you try to claim, but the income is less. So what should we do? We cannot claim the deduction because income is not sufficient. What to do? So we call it as unabsorbed family planning expenditure. It will be same like unabsorbed depreciation. You can claim this amount which you are not able to deduct now in the next year, in the further next years. For unlimited number of years you can claim it as deduction. Till you exhaust the entire amount, you have the option to claim it as deduction. So there is no restriction on number of years also. Same like unabsorbed depreciation, you can claim it as deduction. Okay, right. If suppose this capital equipment or building which you actually constructed for family planning, the capital expenditure which you incurred, if you sell such building, if you sell such plant and machinery, On the sale, how to calculate the income? The answer is, when you sell scientific research assets, how you calculate the income, right? When you sell the scientific research assets without using for any other purpose, how you calculate the income? Same way here also it should be calculated. You remember that your sale consideration or cost of the asset, whichever is lower, I was to tell, that becomes your business income. And I said anything more than original cost will become capital gain. Same thing will apply here. Okay, chalo, you understood family planning expenditure. Now there is a section 36 clause 1, subsection 1 clause 12. It talks about a corporation, it talks about a body corporate. Now please remember, this body corporate should be created by the parliament, state legislature or a province. Like I can say, like your oil and natural gas corporation, national thermal power corporation, life insurance corporation, general insurance corporation. So these are the corporations which are created by the government. Now these organizations have their special law, special act, because when parliament creates any corporation or state legislature creates any corporation, they have their own law, they have their own purpose, which is notified by the central government or state government. Now as per the purpose, if they spend anything, then it is allowed as deduction under section 36 subsection 1 clause 12. Now there is one more point called as credit guarantee fund. If public financial institutions, simple example LIC, UTI, they contribute any money to credit guarantee fund, that is allowed as deduction under section 36 subsection 1 clause 14. Securities transaction tax, commodities transaction tax. Now suppose you are trading on a stock exchange, you pay some tax to the stock exchange, that is securities transaction tax. If you are trading on a commodities market like MCX and all, you actually pay tax to the commodity exchange. So securities transaction tax under section 36 subsection 1 clause 15 and commodities transaction tax under section 36 subsection 1 clause 16. Obviously you can claim it as deduction only if the income from that transactions is taxable under pgbp. If the income is taxable under pgbp, then the taxes paid like STT and CTT, that will be allowed as deduction, right? And if you are purchasing sugar cane, then as per the government rate you will get the deduction on the purchase of sugar cane. Less than that also you can get, or up to that you can get, but more than the government rate you cannot claim it as deduction. That is what section 36 subsection 1 clause 17 talks about. This mark to market losses as per ICDS is a redundant concept. It's a worst it is actually wrong given in the CMA textbook. I also copied it like that, but that expenditures cannot be claimed as deduction. देखो, expenditure should be actual to claim it as deduction, correct? If it is dummy expenditure, can you claim it? No, not allowed, correct? Let the expenditure actually be incurred, then only you can claim it as deduction. Institute has given it wrong, so you can cut this point. 21st point you can cancel it. Okay, hope everything is clear to you. Now come to section 37, general deductions. So we discussed till now deductions under section 30 to 36, correct? In all these sections we got a specific item that this is allowed as deduction, this is allowed as deduction. But what about all other items like salary to employees, like audit fees to your chartered accountant, like printing and stationery expenditure, right? Legal expenses you pay to lawyer. Where will you claim these deductions? And these deductions are claimed under section 37. So what they say, that the expenditure should be real, not notional, not nakli, right? The expenditure should be incurred for the purpose of business. The expenditure should not be personal nature, expenditure should not be capital in nature. That means it should be for business, it should be revenue in nature, and the expenditure should be lawful. Suppose if it is unlawful, then it is not allowed as deduction. Advertising expenditure allowed as deduction, printing expenditure allowed as deduction, purchase of goods allowed as deduction here itself. Okay, because sync, remember that first thing, purchase of goods, advertisements, audit fees, stationery, printing, legal charges, these are all real expenditures. These are required for business. They are not personal because they are for business. They are recurring in nature, so they are not capital, they are revenue, and it is all right as per the law. Then you can claim it as deduction. Okay, now if any expenditure is prohibiting the law, then such expenditure is not allowed as deduction. I'll tell you how I forget actually the names of these institutions, but anyhow, chalo, let me explain with a example what happens actually. Today only I heard a news that Pakistan is funding some institutions like Sikh for Justice. Then there is something called as, there are many institutions like Peace Institution. There is something called as Student Federation of India, SFI. Presently it is legal. So yeah, so these institutions are basically funded by terrorist organizations, ISI organizations, and many Western countries want to create disturbances in our country, so they also fund. Now, as per the government's policy, FCRA policy, foreign contributions, right? Regulation authority, some law is there. So, as per that law, you should properly take a license from the government and you should open a bank account in State Bank of India, especially in New Delhi branch, to get the donations or contributions from foreign country. But these institutions consistently try to break the law. Now, when they break the law in our country, can they get any deduction for any expenditure in relation to the laws, in relation to the expenditures what they are incurring, which is by breaking the law? If they are like giving money to create riots and disturbances in India, can they claim deduction? Suppose any expenditure they incurred outside India, but it is not legal as per the law in that country, can we allow it as deduction? The law was silent till now, but Finance Act 2022 brought this change, and they very clearly, elaboratively they said that if any expenditure is prohibited as per Indian law or as per foreign law, then not allowed as deduction. Are doctors, especially, patient comes to the doctor, 10 rupees medicine the doctor can give and the patient can be cured. But these medicine companies, lot of perquisites they give to doctors. Foreign travel they give. If you want AC, they will give AC. If they want fridge, they will give fridge. So non-monetary, monetary benefits, lot of things they give. Now, is this right as per the ethics, as per the medical profession? There is some law in 2022 created. It is not at all right. So the companies want to claim the freebies what they are distributing to doctors as deduction. Is it allowed for the companies? such expenditure is not allowed as deduction. Moreover, because the doctors received it, it becomes an income under business and profession or under other sources and will be taxable to the doctor. So doctor received it, for him it is taxable. But for companies, they are spending, it is not allowed as deduction. Moreover, the license of the doctors may also be cancelled if they are found in some illegal activity receiving such freebies for unfair actions which they may be taking. Right? So like this we have to understand all the topics. Simply remember, expenditure which is unlawful in India or outside India will not be allowed as deduction. In this exam, June 2023 or December 2023, compulsorily a question will arise on this topic. A small 3 to 4 lines case study may be asked for 2 marks. Right? So if it is prohibited as per the law, it's void. It's not allowed as deduction. Some adjustment may be given in the long question. So be ready for this. Right? Okay, last point we will try to do. Okay, one more thing. If you are doing advertisements in political party souvenirs, if advertisements are done by businessmen or the companies in political party souvenirs, it is not allowed as deduction under section 37 2B. Okay, why? Because they give deduction under section 80 GGB. Right? If it is a company business, 80 GGB. If it is other than company like individual business or partnership business, then 80 GGC. They will get deduction there. That's why it is not allowed as deduction. Advertisement in political party souvenirs not allowed as deduction under section 37 2B, but allowed under 80 GGB GGC. GGB for companies, GGC for other SSCs. Okay, last thing. Suppose certain expenditure is claimed, incurred, but it is partially for business, partially for personal purpose. Like I have a car, I am using partly for business, partly for personal. So car petrol expenses, car depreciation, can I claim totally in the business itself? The answer is no. You have to create a ratio, how much you are using for personal, how much you are using for business. Only business portion will be allowed as deduction. Personal portion not allowed as deduction. Who says? Section 38 says this. Okay, only that expenditure which is pertaining to business will be allowed and which pertains to personal not allowed. This is what you should remember. With this, we completed section 36, 37, 38. We'll continue with other sections in the next video. Till then, take care.